Today, we're going to take a look at Chapter 15, which is dealing with how to prepare and interpret a statement of cash flows. All right, so Chapter 15, Statement of Cash Flows. So setting the stage. The statement of cash flows highlights the major activities that impact cash flows and hence affect the overall cash balance. The statement of cash flows helps to answer a variety of questions, such as are we generating sufficient cash flows from its operating operations to remain viable? Can we pay our debts? Can we pay our usual dividend? Why do net income and cash flow differ? And to what extent will we have to borrow money in order to make needed investments? The statement of cash flow is based on the principle that properly analyzing the changes in all non-cash balance sheet accounts will always quantify the cash inflows and cash outflows that explain the changes in the cash balance. The basic equations for assets, contra asset, liabilities, and stockholders' equity accounts shown on this slide will be useful in preparing a statement of cash flows. So the basic equation for our asset accounts would be the beginning balance, adding our debits, and then subtracting our credits. That would give us our ending asset balance. And then the basic equation for all of our contra asset accounts, our liabilities and stockholders' equity would be the beginning balance minus our debits plus our credits equals our ending balance. The term cash on the statement of cash flows refers broadly to both currency and cash equivalents. And so again, our cash that we have on hand, physical cash, as well as the money that we have in bank accounts, that would be considered cash. So cash equivalents would include our treasury bills, commercial paper, and money market funds. Those would be examples of different cash equivalents. All right, so our first learning objective is to classify cash inflows and outflows as relating to operations, investing, and financing activities. So breaking down each of those. So the statement of cash flows is organized into 3 sections that report cash flows resulting from operating activities, investing activities, and financing activities. And so operating activities are revenues and expense transactions that affect net income. Investing activities are acquiring or disposing of non-cash assets, and then financing activities are the borrowing from and repaying of principal to creditors and transactions with stockholders. This slide summarizes the most common types of cash inflows and outflows resulting from operating, investing, and financing activities. And we see here broken down as cash inflows and cash outflows. So again, operating activities would be, for example, of collecting cash from customers, paying suppliers for inventory, paying bills to insurers and utilities, paying wages and salaries to employees, paying taxes to governmental bodies, paying interest to lenders. Investing activities would include buying and selling plant, property, and equipment, buying stocks and bonds as a long-term investment, buying and selling stocks and bonds, lending money to another entity, and collecting the principal of a loan to another entity. Those would all be investing activities. Financing activities would be borrowing money from creditors, repaying the principal amount of a debt, collecting cash from the sale of common stock, paying cash to repurchase your own common stock, and then paying a dividend. So it'll all be examples. Now, the net amount of cash inflows and outflows resulting from operating activities, which is known formally as the net cash flow provided by operating activities, can be derived from either the direct or the indirect method. So under the direct method, the income statement is reconstructed on a cash basis from top to bottom. For example, cash collected from customers is listed instead of revenue, and cash paid to suppliers is listed instead of cost of goods sold. Under the indirect method, net income is adjusted to a cash basis. That is, rather than directly computing cash sales, cash expenses, and so forth, these amounts are derived indirectly by removing from net income any items that do not affect cash flow. Okay, learning objective 2. Compute net cash provided or used in operating activities using the indirect method. So key concept number 3. The indirect method adjusts net income to net cash provided by operating activities using a 3-step process that we see here. So the first step is that we need to add depreciation charges to net income. The second step is that we would analyze net changes in non-cash balance sheet accounts. The third step is we would adjust for gains and losses. The first step is to add depreciation charges to net income. The basic equation for contra accounts shown here on this slide can be used to determine the amount of this adjustment. And so again, that equation is the beginning balance minus our debits plus our credits equals our ending balance. So we assume the beginning. So in an example here, if we assume that the beginning and ending balances in the accumulated depreciation account are 300 and 500 respectively, also assume that the accumulated depreciation on equipment sold during the period was $70. So given these assumptions, the basic equation for contra assets can be used to compute depreciation charges of 270. So we have the beginning balance minus our debits plus our credits gives us the total. So the ending balance was 500. We had a beginning and an ending. We want to know what the credits were. And again, you can work that out algebraically. And in this example, the basic equation for contra assets can be used to compute depreciation charges of 270. The second step is to analyze the net changes in balance sheet accounts that affect net income. To complete this step, you begin by computing the change in the balance of each current asset and current liability account. If a current asset account balance increases or decreases, then the amount of the increase or decrease is subtracted from or added to net income. If the current liability account balance increases or decreases, then the amount of the increase or decrease would be added to or subtracted from the net income. And so we see that here on this slide. Now, the third step is to adjust for gains and losses included in net income. And under the U.S. generally accepted accounting principles and the international financial reporting standards, they require that gains and losses to be disclosed in the investing activities section of the statement of cash flows. Therefore, we reverse the impact of gains and losses on net income by subtracting gains and adding losses. All right, so learning objective 3, compute net cash provided or used in investing activities. So again, under the U.S. generally accepted accounting principles and the international financial reporting standards, they require that the investing and disclosure and financing sections of the statement of cash flows disclose gross cash flow. So when the balance is in a non-cash asset account increases or decreases, it signals the need to record a cash outflow or cash inflow in the investing activities section of the statement of cash flows. However, computing the correct amount of cash flows requires further analysis, as you'll see shortly. When the balances in bonds payable and common stock increase or decrease, it signals the need to record a cash inflow or a cash outflow in the financing activity section of the statement of cash flows. However, computing the correct amount of cash flows also requires further analysis. The retained earnings account also requires further analysis to quantify the amount of dividends. And so to illustrate how to compute gross cash flows, let's use the property, plant, and equipment account. Let's assume the information as shown in the top half of this slide. So again, so we see here what you see there. So based on this information, the company will record a cash inflow of $40 related to the sale of equipment. The basic equation for assets can be used to determine that the company would also need to record a cash outflow of $900. All right, so now we're on learning objective 4, which is to compute the net cash flow provided or used in financing activities. So as another example, let's look at the retained earnings account and assume the information as shown at the top half of this slide. The basic equation for stockholders' equity can be used to determine that the company would need to record dividends, which would be a cash outflow of $200 in the finance activity section of the statement of cash flows. Summary of the 5 key concepts. This slide summarizes the 5 key concepts related to preparing the statement of cash flows. So slide 22 and 23, you have in our Canvas shell on this lecture page, you have a link to be able to download the slides down towards the bottom, the PowerPoint slides. And so you might want to do that. And so for 22 and 23, you can, of this, you can have this information where it's summarizing what we just went over. All right. So now learning objective number 5 is we're now going to go ahead and prepare a statement of cash flows using the indirect method to calculate the net cash provided by operating activities. And we're going to take a look at a company called Apparel Inc. And so let's assume that Apparel Inc. reported the income statement that we see here. So they had sales and cost of goods sold, gross margin, and everything. It came out that they had a net income of $140 million. And then let's assume that the company reported the balance sheet that we see here. So they had we see here their balance sheet where they were at for assets and then liabilities and equity. So let's assume the additional information that we see here with their liabilities and equity. All right. So now computing net cash flow provided by operating activities is a 3-step process. And the first step in computing the cash flow provided in operating activities is to add depreciation to our net income. And the basic equation for contra asset accounts can be used to determine that Apparel should add $103 million of depreciation to their net income. And so in addition to the financial statement, we can assume the following. I think there might have been a mistake here. So we'll come to that. But anyway, so the company sold a store that had an original cost of $15 million and accumulated depreciation of $10 million. The cash produced from the sale was $8 million, and the gain on the sale was $3 million. The company did not issue any new bonds during the year. The company did not repurchase any of its own common stock, and the company paid a cash dividend during the year. Okay. So now we're looking at this adding, I'm sorry, they had a mistake here. So we worked this out and we figured that we need to add 103 million to our net income to encompass our depreciation. And we see here how you would figure that out. Now, the second step is to analyze the net changes in non-cash balance sheet accounts that impact net income. And we see here the different things. So they're increases in their account balances and so on and so forth. So we work that out. Now, okay, let me go back. So on this, yeah. So on this, we see that the accounts receivable balance decreased by $17. So that amount needs to be recorded as added to that income, or probably in millions. The inventory balance increased by 49 million. So they had to add that, subtract that from the net income. Accounts payable increased by 44 million. So we're going to add that to our net income. The accrued liabilities balance increased by 3 million. So we're going to add that to our net income. And the income taxes payable balance increased by 4 million. So we're going to go ahead and add that back to our net income. So now the third step is to adjust for gains and losses. And so if we remember from what we looked at before, that apparel's income statement includes a gain of 3 million. So that amount has to be subtracted from net income because it's not from operating activities, it's from them selling a store that I guess they no longer needed. And then subtracting the net gain on sale removes it from the operating activities section of the statement of cash flows. The entire amount of the proceeds related to this sale will be recorded in the investing activities section when we get there. The operating activities section of apparel's statement of cash flows would appear as shown in this slide. So we have our net income, then we would have which are all things, some of these are things we would subtract from it or add to it, but we have our depreciation, and then we have our decrease in accounts receivable, our increase in inventory, increase in accounts payable, increase in accrued liability, increase in income tax payable. And then we would subtract out our gain on the sale. And then that gets us the amount of cash that was used in operating activities, which was 259 million. Now, investing activities. To compute the gross cash flows in the investing activities section of the statement, we would focus on the plant, property, and equipment account. The Apparel Inc. would record an $8 million cash inflow related to the sale of the store. So we see that right here. Now, the basic equation for asset accounts can be used to determine that Apparel needs to record $138 million cash outflow related to the purchase of plant, property, and equipment. And we calculate that using this. So we take our beginning balance, we add our debits, we subtract our credits. That gets us our ending balance. All right, so financing activities. To compute the gross cash flows in the financing activities section of the statement, we would focus on the bonds payable, common stock, and retained earnings accounts. To compute the gross cash flows, okay, so we did that. Now, the balance in bonds payable decreased by 41 million because the assumptions state that Apparel did not issue any bonds during the year. The 41 million decrease relates to retiring bonds and represents a cash outflow. And then the balance in common stock increased by 2 million. And that's because the assumptions state that Apparel did not repurchase any of its own stock. The $2 million increase relates to issuing common stock, and so they would have received cash in exchange for issuing common stock. The basic equation for stockholders' equity accounts can be used to determine Apparel paid dividends in the amount of 28 million that need to be recorded as a cash outflow. So Apparel's completed statement of cash flows is shown on this slide. Notice that the net increase in cash and cash equivalents of 62 million explains the change in cash balance. Okay, and then T accounts can be used to summarize changes in Apparel Inc.'s non-cash balance sheet accounts, quantify the cash inflows and outflows that explain the changes in their cash balance. So the first entry records Apparel's net income of 140 million in the credit side of the retained earnings account and on the debit side of the cash account. The second entry adds depreciation of 103 million to net income. Entries 3 through 7 adjust net income from the changes in the current asset and current liability accounts. Entries 8 through 11 summarize the cash outflows and inflows related to property, plant, and equipment, the retirement of the bonds payable, the payment of cash dividends, and the issuance of common stock. And the final entry, 12, records the sale of the store. Notice that the gain on the sale, or 3 million, is recorded in the credit side of the cash account, so that the entire amount of the cash proceeds from the sale, or 8 million, can be recorded as investing activity. Interpreting the statement of cash flows. Consider a company's specific circumstances. So startup companies often would have a negative cash, negative net cash provided by operating activities, large spikes in net cash used in investing activities, and net cash provided by operating activities. As startup companies mature, the net cash provided operating activities should swing from a negative to a positive number. The net cash used for investing activities should decline somewhat and stabilize, and the net cash provided by financing activities should also decrease. Consider the relationship among the numbers. Some managers study their cash flow trends in cash flow margins by comparing net cash provided by operating activities to sales. Managers also compare the net cash provided by operating activities to the ending balance of current liabilities to see if they are generating enough cash flow to pay their bills at the end of the period. Some managers also compare the additions to property, plant, and equipment in the investing activities section of the statement to depreciation included in the operating activities section. If the additions of property, plant, and equipment are less than depreciation, it suggests that the company is not investing enough money to maintain its non-current assets. And now we'll look at learning objective 6, which is to compute free cash flow. Free cash flow looks at the relationship among three numbers from the statement of cash flows: net cash provided by operating activities, additions to plant, property, plant, and equipment, and cash dividends. Free cash flow measures a company's ability to fund its capital expenditures and dividends from its net cash provided by operating activities. The equation of computing free cash flow is net cash provided by operating activities minus our capital expenditures and dividends. And in this example, apparel's free cash flow of 93 million is shown. So we would subtract 259 million, which is our net cash that was provided by operations, minus our capital expenditures of 138 million, minus our dividends of 28. That gets us our free cash flow of 93 million. Managers and investors look at the relationship between net income and net cash provided by operating activities to assess earnings quality. Managers perceive that earnings are of higher quality when the earnings are not unduly influenced by inflation, are computed using conservative accounting principles and estimates, and are correlated with net cash provided by operating activities. All right, so now we're going to look at Appendix 15A method. So what we looked at before was the indirect method. This is now the direct method. So 15A is the direct method of determining the net cash provided by operating activities. So this is the direct method. Hold on just 1 second. So again, Appendix 15A, the direct method of determining the net cash provided by operating activities. So this is, again, the direct method. What we looked at before was the indirect method. So learning objective 7 is to use the direct method to calculate the net cash provided by operating activities. Okay, so computing net cash provided by operating activities. The direct method computes net cash provided by operating activities by reconstructing the income statement on the cash basis from top to bottom. The amount of net cash provided by operating activities under the direct method will always agree with the amount computed under the indirect method. So it's going to agree, the net cash would be the same regardless, but similarities and differences in the handling of data. The adjustments for accounts that affect revenue are the same in either the direct or the indirect methods. In either case, increases in the accounts are deducted and decreases in the accounts are added. The adjustments for accounts that affect expenses are handled in opposite ways for the direct and indirect methods. So the adjustments for accounts that affect expenses are handled opposite ways between the direct and the indirect method. Under the indirect method, the adjustments are made to net income, whereas under the direct method, the adjustments are made to the expense accounts themselves. So for example, in the indirect method, an increase in prepaid expenses is deducted from net income. However, in the direct method, an increase in prepaid expenses is added to operating expenses. Now, regarding gains and losses on the sale of assets, no adjustments are needed at all under the direct method. These gains and losses are ignored because they are not part of sales, cost of goods sold, operating expenses, or net income. So they get ignored, gains and losses. Now, when a company uses the direct method, it must prepare a reconciliation between net income and the net cash provided by operating activities. If it uses the indirect method, it must disclose the amount of interest and income taxes paid during the year.